Okay, hello everyone. This is Randy Nordby again. I'm here to talk to you now about our trade strategy and execution. So we've already done the portfolio analysis. We built the portfolio. Now as a portfolio manager, it's out of our hands. We've sent it over to the trading team. So we want to find out, hey, how did they do? How was the execution? And we also want to think about, well, what strategies do we want to use? And the more that we understand the trading process, which we're going to emphasize here in today's reading, this only helps us as a portfolio manager. So you can understand what is your trading team doing, what obstacles do they have to do, and maybe you can be part of the process. When I was a portfolio manager, I didn't have anything to do with the trading. I didn't know exactly what they were doing. I didn't really even want to know exactly what they were doing. But now it's very important, and it is part of the CFA exam, and it's another piece. We have to evaluate our trading team. How are they doing? And at the end of the day, are they doing things that are hurting the performance of my fund? Okay, so let's jump into this material. So again, this section we're going to cover trading, and we're going to get into execution. So this topic, and for the exam, I want you to think about, we're going to evaluate the actual trade component of the portfolio management process. And one of the ways that the CFA Institute tackles this material that I really like, we're going to look at trade motivations and trade characteristics. And we're also going to incorporate our capital market expectations. Because here's the thing, we want to now execute the most appropriate trading strategy. What if there's a particular security that you want to buy, it's just not possible to obtain? So maybe you need the second best strategy. So we're going to get into this. So understanding the trade motivations and the trade characteristics are really going to help the trader and the portfolio manager understand how to execute this trade. And then, of course, we have to factor this in with our capital market expectations to have a real complete trading strategy. So what are some key factors? Well, what I love about what the CFA material does is it seems like over the last 10 to 15 years, I hear a lot of firms talking about execution, and they focus on commissions. And my friends are always talking about, hey, I can go to this company and I can trade unlimited shares for $4 or $3. We tend to focus on this explicit costs. What the material reminds you is that there are also implicit costs. And in fact, these implicit costs are most likely much, much higher than your explicit commission cost. And quite honestly, you can't just pick a company that executes at the lowest cost. That is not the definition of best execution that we're going to get to soon. Okay, so what is this section all about? What is this today's reading all about? It's implementation shortfall. When you go back and look at previous exams, and again, I expect you to go back and look at previous exams, I need you to realize, and you'll see very quickly, that there's so many questions on implementation shortfall. This is by far the #1 topic in the trade strategy and execution section. You are going to have to understand implementation shortfall, and you're going to have to decompose that implementation shortfall. Let's say your implementation shortfall was $25,000. It's really easy to calculate that. We'll show you how to do it. But now you're going to have to decompose it into its 4 components, and we need to figure out where are we falling down or where are we doing well. So again, implementation shortfall is heavily tested. Now, I didn't see a lot of focus on this in the material, but I want to bring this back a little bit. Some of the other measures out there, like volume weighted average price, VWAP, and other methods, traders can game those trades to make them look like they're doing a better job. or maybe they just hold off trading because it's not a good time. So a lot of the methods out there are very easy to game by traders. Implementation shortfall is extremely difficult to game by traders. So I like implementation shortfall. It's a better, true representation of what really happened and who's to blame or who's rewarded. Okay, so I cannot stress enough, you are going to have to know implementation shortfall for the exam, and you're going to have to decompose it into those cost, delay, trading, opportunity, and fixed fees. So explicit cost and implicit cost. Now, let's talk about why do people trade? What are the trade motivations? Because what we're going to find, your trade motivations are going to help you understand how to execute that trade. If you need to do something immediately, there are certain strategies that are for immediate trades and strategies that don't work so well for immediate trades. So I need to understand the motivation. First one, motivation, profit seeking. I even like how this is the first one. But maybe there's risk management hedging needs that have to be addressed also. Maybe we need cash flow needs. Maybe we just had a major redemption and I've got to generate some funds. Or maybe there's corporate actions or margin calls, or maybe the index changed. So again, I think it's important to understand these four categories of trade motivation. But again, implementation shortfall is where I really want you to spend your time. But it's important to understand this background material as well. So what's profit seeking? Well, if I'm an active portfolio manager, I want to outperform whatever my benchmark is. I'm hunting for alpha, the holy grail of investing. Me personally, I spent about 10 years of my career chasing alpha. I don't do that anymore. I'm now focused more on risk and risk management, but a lot of people are still hunting for alpha. If I'm an active portfolio manager, I need to generate alpha, and I'm doing this because I believe trades are mispriced, and I've got to go in there and exploit that opportunity. So when you're having an active portfolio manager, we have an issue about alpha decay. If there's a price inconsistency, how long is this going to last? I'm not going to be able to put this trade in 3 weeks. I may need it to be put in this very moment, this very second. Okay, so alpha decay, this is that deterioration of this alpha once the decision is made by the portfolio manager. How long do we have to implement this trade? So again, this is associated with active portfolio managers who believe that they can outperform the market. Some markets are easier to do this than others, but I need you to be familiar with the term alpha decay. And if there's a lot of alpha decay and you're a profit-seeking motivated portfolio manager, you're going to have an appropriate strategy that executes this trade quickly. Okay, alpha decay. I want you to think about there's a higher trade urgency. If there's a higher rate of alpha decay, I'm trading on this brand new news, this thing that just came out. I need to trade in a shorter time frame. Now, there could be lower trade urgency. So maybe like myself, I valued firms on long-term fundamentals. I had lower rates of alpha decay. I didn't need the trade to be placed immediately. I want the trade to be placed at the price that I want, and I can wait around for it. I don't need it immediately. So we have a short time frame with higher trade urgency, and we have a longer time frame. Now, I'm not saying 5 years from now, but I might be saying, hey, go ahead and execute it over the next week at this price, or maybe the next day, but I don't need it done immediately. Okay, information leakage. If I'm worried about alpha decay and I'm an active portfolio manager, I want to be really careful about alerting the market to what I'm doing. If I find a mispricing, I don't want people to profit from my work. So what can we do to minimize information leakage? Well, we might instruct our trading department, or our trading department, they're professionals too. They may decide to execute the trade in multiple venues and at multiple times. So they're not just trying to jam down one huge trade immediately. Okay, now what is this going to include? They may trade in less transparent venues called dark pools. What is a dark pool? It's just a trading system with very little pre-trade transparency. Okay, there are a lot of things that are traded in dark pools. You can read about the trading strategies. You can read about Flash Boys and other stories that we're hearing about dark pools, and just be familiar of the pluses and minuses. The pluses of a dark pool: nobody knows I'm doing this, so I don't have to worry about information leakage. But the weakness or the negative of that dark pool, I have no idea about the pre-trade transparency. Maybe they can't handle my trade in that market. Okay, so with dark pools, we talked about advantages. Orders can't be seen. So guess what? There is no risk of information leakage. Now, there are execution venues with high pre-trade transparency. Those are called lit, L-I-T venues. What does that mean? It's a national stock exchange. So what's a disadvantage of this dark pool? Traders can't see orders on the other side, so they have no idea the likelihood of execution. Okay, so if you're extremely worried about getting executed and getting this trade executed, you probably might want to think twice about using dark pools. Or maybe that risk is acceptable because you just can't let anyone else see what you're doing. This information leakage overshadows this likelihood of execution problem. Okay, the other trade motivation we talked about after profit seeking is risk management or hedging needs. So portfolios have to maintain their approved risk exposures. So we could involve rebalancing the portfolio after market conditions, or maybe we just want to hedge to remove a risk factor. Maybe we decide that we're concerned about a particular factor that we've identified, and we just want to remove that from the portfolio. Okay, we can use derivative trades to facilitate risk management. Now, they do use leverage, but we can monitor this leverage, and we can monitor it closely because derivatives imply leverage, and we have to be careful because leverage magnifies risk. And if I'm trying to use derivatives for risk management, I have to know what I'm doing, because if I'm trying to lower risk, I could actually significantly raise risk if I don't handle leverage correctly. A third motivation, how about cash flow needs? I saw this all the time with mutual funds. So they're primarily caused by investor subscriptions, inflows, and redemptions, outflows. So the trade urgency is going to depend on the nature of that cash flow. Hey, maybe a hedge fund only trades once in a while, so they may require months' notice or even longer to actually trade. So there's not a lot of trade urgency with a hedge fund to invest that money. Now, if you have less liquid holdings, you actually may find it very difficult to invest these new client funds quickly. So what results? Well, cash drag. Now, if the market crashes during that time, great. That's positive. But if the market takes off and you can't invest, you're going to be exposed to cash drag. So we can do things to handle this cash drag problem. Okay, so what can we do to limit cash drag? One strategy that I'd like you to be familiar with, a PM can use an equitization strategy. What does that mean? We're going to use a liquid security, maybe a liquid ETF or liquid derivative, to gain that market exposure until we can get that underlying security invested. couple things just to know. Client redemptions are frequently based on NAV, and the easiest thing to do is use closing prices of those securities. Now, if you liquidate securities at closing prices, what that's going to do, it's going to eliminate the risk of selling at prices that are different than these closing prices. So a PM's going to have to juggle a few things here. They're going to have to consider liquidity and taxes when they're trying to meet these redemption requests. And the easiest process is just focus on the closing price of the securities. It'll make things a little bit easier for you. Okay, and then finally, the fourth trading motivation that's mentioned in the literature are corporate actions, margin calls, and index reconstitution. So corporate actions, what if there's a merger, an acquisition, or a spinoff? We may have to trade. We're going to get dividends or coupons from time to time. Going to have to invest those. We may have regular distributions that we have to make, and let's say we don't have enough cash, we may have to sell some securities, and then unfortunately a margin call may require a very urgent sale of portfolio holdings. So again, what we're trying to do is paint the picture of some of the motivations that you're using. If you can understand the motivation that's happening in the case, you're more likely to pick the appropriate trading strategy. Okay, so let's talk a little bit about benchmark index reconstitution. So if you have tight risk tracking error methods, you're going to need to execute trades sometimes very quickly to continue to match that index fund. So the value of this benchmark is usually based on closing prices. Therefore, if you trade at closing prices, you're going to minimize tracking error in relation to the benchmark. Okay, so now we've gone through the motivations, we've gone through some strategies. Now let's look at some inputs. So once the portfolio manager makes that decision to invest, the executing trader and the portfolio manager are going to have to work together to create an optimal trading strategy. Now, what are some key factors? And for the exam, I would like you to be able to do a couple of these. Come up with 2 or 3 of the key factors. I think these are very important to know for the exam. So what are some key factors that you need to know for an optimal trading strategy? Well, you need to know the order characteristics. We've already talked about how the motivations kind of get into that. I want you to understand the security characteristics. Is there something about this particular trade? Mutual fund trades at the end of the day, or this ETF trades immediately, or this private equity fund I might not be able to trade for a long time. I also need to understand market conditions, and then finally, risk aversion. So all 4 of these are key factors. So let's dive into these a little more. Order characteristics. In the literature, you're going to hear the term side. What does that mean? It just means the direction of the order. Are you buying? Are you selling? Are you short selling? And what does this mean? Well, if you're just trying to do a bunch of buy orders or a bunch of sell orders, you've got greater market risk exposure versus a list of buys and sells with offsetting market risk exposures. Okay, and then there's a question about absolute size. Larger orders are going to have higher market impact. And because it's such a big order and it's going to have major market impact, what generally happens, they're often traded with less urgency. Okay, so order characteristics, we can get into the motivations that we talked about, but now we're getting into the actual order. And what are these characteristics? So, what direction are we taking? What is the size of that order? And the other thing I want you to think about is size is one of those ideas in trading that a portfolio manager really needs to get a handle on. If you're trading, the whole market volume for the day, you're going to have to know you're doing that. If you're trading a small portion of the order or the average daily volume, you need to know that as well. So the literature talks about a portfolio manager should look very closely at the order size as a percentage of average daily volume. We're institutional traders, let's say, well, we're going to have a bigger impact. We're going to be placing bigger trades. We're going to be tracing more of that average daily volume. Okay, so the general rule that I want you to think about, if your order is a higher percentage of the average daily volume, well, it's most likely going to have a higher market impact cost. So your trader and your team has got to figure out ways to minimize that impact cost. Okay, so let's jump into security characteristics. So they include security type, short-term alpha, price volatility, security liquidity. So security type, guess what? Different security types have different trading techniques, different cost, different methodologies, different markets, different regulations, and most importantly, I think, different liquidity. So it's very, very important that this isn't the first time you've traded this security before. Short-term alpha. Remember we talked about this with alpha decay. If there is a large amount of alpha decay, then you're going to trade with more trade urgency. You got to get this trade done. I don't care what it costs me. Make it happen. Okay, so the portfolio will also have higher urgency in adverse markets. So buying into a rising market or selling into a falling market. So again, this idea of short-term alpha, again, becomes important in this section. Price volatility. If you have volatility in your prices, what does that imply? That implies high execution risk, or the risk that an adverse price movement is going to occur. Now, there can also be security liquidity. So if there's a lot of security liquidity, it's going to lower execution risk and market impact cost. So kind of take a step back. You're trading. Two major things I want you to think about are execution risk, and then I want you to think about impact cost from the trade. Because there might be a chance you won't even get the trade done, and then also these impact costs. So I think it's important sometimes you can get lost in the minutia in this trading section, but it gives you a good overview of what's happening, but don't lose sight. Implementation shortfall is what we really want to key on here, but we're still going to get some questions in trading that we're going to need to be able to answer. So I want you to think about how a trade is going to impact execution risk, and I want you to think about impact cost. We talked about security liquidity. If there's greater liquidity, well, it should lower execution risk, and it should also lower this impact cost of market trades. So again, always take a step back sometimes and don't get so caught up in the minutia. Okay, and again, what are some things that we can look at? I like this. This is something that I would actually write down on a note card. So what do we know? What do narrower bid-ask spreads tell us? Well, with large volumes for trading, they give us market depth. And they're two key indicators of high liquidity. So if I see a narrow bid-ask spread and I see a very deep market, then I know there's going to be high liquidity. Okay, I may need to trade a lot of shares, so I'm going to need to be aware of these. Okay, market conditions. Absolutely, key market conditions affect trading cost. And we've seen certainly since the financial crisis, but really going back probably to as early as I got into the industry in the 90s, market volatility and liquidity levels, they can change adversely very, very quickly. And so they are very dynamic. They are not static. And traders need to reflect this in their expectations. So if I see lower liquidity, That means I've got a longer trade horizon. So I'm going to have to wait a while before I can trade that security. Am I okay with that? So we've got to keep an eye on liquidity and volatility. Okay, individual risk aversion. This really gets down to the portfolio manager and trader, their individual view. So a portfolio manager trader with higher risk aversion, they're typically more concerned with market risk of adverse price movements. Okay, so they're going to trade with more urgency. So what are they actually doing? They're really concerned, when you think about it, that these security prices, we want to get this trade done. I'm not that worried about market impact cost. So again, I'm going to trade with more urgency, and these trade strategies, they're key factors to the two major costs of trading. We've talked about these: market impact and execution risk. So again, two major costs of trading. Always think about market impact and execution risk. Now, this is the trader's dilemma. I'd like to put a star by this. So we've got some issues here. We've got market impact and we've got execution risk. Which one, as a portfolio manager, as a trader, are we most worried about? So market impact comes from trading too quickly. You tried to trade too many shares at once, and what happened? You adversely impacted the price. We had information leakage, and now everybody knows what we're doing. Execution risk is the opposite. It's not caused by trading too fast, it's caused by trading too slowly. So it's the risk of the adverse price movements over time. The market ran away from me. I wanted to buy it at 20, then it was at 20.10, and then it jumped to 25 and 26, and now it's way past where I wanted to go in. Okay, so this trader's dilemma, I'd like you to be comfortable with that term if it pops up on the exam, and understand and be able to explain what it is. It's just balancing market risk with execution risk. Which one are you most worried about? Okay, and then again, this trader's dilemma, you're going to have to alleviate this execution risk and market risk. There's got to be some balance that you find. So the best way to learn this information, again, is we're going to have to work problems. So I love these examples. So let's look at an example on trading cost. So we've got a portfolio manager. He's discussing a list of buy and sell orders with the firm's head trader. Now the trader is wondering and particularly interested in how order size, security liquidity, and rate of alpha decay affect market impact risk and execution risk. Now the question is, for each of the factors listed, order size, security liquidity, and rate of alpha decay, we want to briefly describe how the factor affects the market impact cost of the trade. So these three factors, how does it impact the market impact cost of the trade? And we want to consider each of these in isolation. Okay, so let's answer question 1 first. What do we know? Well, we know a large order size is most likely going to lead to higher market impact cost. So the trader's going to have to trade at more adverse prices to execute a larger transaction. So they're going to have to think of some different ways, maybe different markets, different venues to lower that impact cost. Now, if we have higher liquidity, well, we can expect narrower bid-ask spreads, and that implies higher market depth, both contributing to lower market impact cost. So what does this mean? It means the trader's likely to be able to execute the trade close to the current market prices. Now, with higher alpha decay, what does that mean? That means the trader's got to trade quickly. If I trade quickly, that means I'm likely to have higher market impact cost. So do you see how all this works together? I love working these problems because it sort of brings the definitions and the terms to life. If you don't work these problems, I just don't think you'll ever get there. So I always find looking at the answers to these questions is a great review of those topics, and I highly suggest you do that as well. So let's look at the second part of the question. The portfolio manager makes the following two statements. Statement 1, high market impact cost could be mitigated by executing the order over a longer trade horizon. Sounds reasonable to me. Statement 2, if done correctly, this will not lead to an increase in any other types of trading cost. Nope, that's not right. So the question says discuss whether the two statements are true and false, and then justify. But notice this term before, briefly, your response. It doesn't say write a 4-page book report. Okay, so answer to question 2. Statement 1 is true. Why? If you execute the order over a longer trading horizon, it means I can slice and dice the order, and I can break it up into smaller pieces, and I can actually lower the market impact cost of the trade. So absolutely that is true. Now, why is statement 2 false? If you execute a trade over a long time horizon, well, that means you're going to have higher execution risk or the risk of adverse price movements. So the longer you wait to trade, the higher execution risk that you face. So again, statement 1 is true, statement 2 is false, and you see the definitions and the justification, a sentence or two here and there. You don't need a lot to write there, okay? Just hit the key points and move on.